Well, hello, welcome, good morning. Appreciate everyone joining us here today for today's webinar on ending U.S. tax incentives for offshoring. Thank you so much to our panelists and thank you to our attendees. Obviously, we wish we were able to do this in person, but appreciate you joining us for our virtual briefing today. I'm Susan Harley. I'm the Managing Director of Public Citizens Congress Watch Division. And we're a member of the FACT Coalition, the Financial Accountability and Corporate Transparency Coalition. And we're co-hosting this today with Oxfam America and FACT Coalition. So thank you again. This is the second of two briefings that the FACT Coalition has held this month. The first, which I hope you were able to catch 2 weeks ago, was on tax transparency and the global trend towards country-by-country tax reporting. If you didn't catch that, there is a recording, and so we'll make sure that you get that. Before we get started, I just want to give a couple of housekeeping notes. First of all, this event is being recorded, so just be aware of that. Secondly, we will have a question and answer session at the end of the panel. And to do that, you'll be using the Zoom Q&A function. So just go ahead and type your question in a written form into the Q&A, and just be aware we are able to have you submit your questions in an anonymous format if that's your preference. And after we go through all the panelists, we'll go to that Q&A session. And if time permits, we'll take people who are joining by phone, who are not online with us today. So for those of you who know Public Citizen, you're probably aware that since our founding nearly 50 years ago, we've been very concerned with the outsized problem of corporate power in the United States and abroad, and companies that put profits over people, whether that's consumers or whether that's their workers. And so if you do trade issues, you're probably super familiar with my colleague, Lori Wallach, who works on trade issues in our Global Trade Watch division. What you may not know is that Public Citizen also deals with offshoring issues from a tax perspective. And as our panelists will talk about, our current tax system that was passed in 2017 under the Tax Cuts and Jobs Act, or TCJA, it didn't fix the problems of offshoring of tax profits and the problem of incentivizing outsourcing of investments. It just created new problems. So our panelists will go through in depth the issues that exist with the current law. And then we'll also talk about some of the solutions, both domestic legislation that fixed the problem, as well as some of the international movement towards the problem of offshoring and tax avoidance generally by multinational corporations. The solutions are many. We want to focus on 3 bills today that will get to the heart of the problem. The most comprehensive of that legislation is called the No Tax Breaks for Outsourcing Act. That is introduced by Senator Whitehouse and Representative Doggett. The bill number for that is S780 and HR 1711. It is the most comprehensive. It has several provisions. The most important of the provision is that it equalizes the domestic and foreign tax rates and changes the provisions known right now as the Global Intangible Low Tax Income or GILTI provisions. It also has some elements that would tighten up the rules around corporations that flee the United States and reincorporate in another country for tax purposes, that problem of inversion. So it tackles both of those issues at the same time. Another bill that the FACT Coalition supports is called Removing Incentives for Outsourcing Act. That's a Senator Klobuchar bill. That's S1610. The most important element of this bill is that it would apply that GILTI rate on a per country basis versus the current worldwide blending system that we have in place. And then another bill that just deals with that inversion problem is called the Stop Corporate Inversions Act. That's a Senator Durbin bill, S2140. Those anti-inversion provisions are, for the most part, included in the No Tax Breaks for Outsourcing bill, but it basically puts in place rules that would determine when a formerly US company should still be considered domestic for tax purposes. So, these bills have a tremendous amount of support. In particular, the no tax breaks for outsourcing bill is hugely popular, both on the Hill and with groups outside of the Hill. So it is co-sponsored by a majority in the House of Democrats, including a majority of the Democrats on Ways and Means Committee. And it has a very diverse co-sponsorship. It has not only Colin Peterson, a founding member of the Blue Dog Coalition, but everyone, including AOC. So, great representation of Democrats in support of the legislation. There's also a tremendous amount of support, not just from the panelists who are here with us today, those representing the labor community, those representing small business, NGOs concerned with humanitarian issues in the international sense, but many different other labor unions that are not here today, including AFSCME, Communication Workers of America, SEIU, Teamsters, NEA, American Federation of Teachers, Steelworkers, Food and Commercial Workers, Unite Here. I could go on. So a huge list of supporters. Also, think tanks are in support, faith groups, coalitions, not just the FACT coalition, but other coalitions that care about homelessness or poverty. So a tremendous amount of support on these particular bills and the no tax breaks for outsourcing act in specific. But that's enough for me. Definitely you'll hear more from our panelists on this issue. And thanks again so much to our panelists for taking the time today. We really appreciate it. You'll hear from them on their perspectives about the problem as well as the solution and how we can end the current incentive that exists in our tax system for outsourcing of jobs and investments. Let's get started with Dr. Kimberly Klossing. She's the Miller and Mintz Professor of Economics at Reed College. And then Kim, before you get started, don't forget to unmute yourself. So thank you.
Thanks, everyone. I'm just going to share my screen because I've got some slides coming up here that you should see now. Hopefully, give me a wave if you see them. Yes. Okay, good. So I just have 5 minutes, so this is going to be very quick. So I've included my emails at the bottom. If you have any follow-up questions, all of them go to the same place and I'll see them. I'm at Reed now, but I'm moving to UCLA. So this looks at tax policy options for reducing offshoring and profit shifting, and there are 4 real problems with the current system. One is that the corporate tax itself is really important for a lot of our policy aims, for equity, for efficiency, because a lot of these taxes fall on companies with market power, which makes them a pretty efficient tax, but also just as any way to tax capital income. Actually, if you go to this picture, you see that most capital income is untaxed by the US government at the individual level. So our corporate tax is really one of the only ways to reach capital income at all, because only about 30% of accounts are taxable by the US government. But also the current law encourages offshoring, both the GILTI, which allows a 10% exemption for return on assets offshore and gives you a direct incentive to have more assets offshore, but also the export subsidy in the law, which is less generous as you have more US assets. So in combination, they both encourage foreign assets relative to US assets. Both current and prior law encourage profit shifting. That's a huge problem that I'll show you some evidence of in a second. And we also have this problem of tax competition, which is other countries keep their rates low too, and that gives us an incentive or a desire to sort of match the competitiveness of those countries. If you look at the US, you'll see that corporate profits are quite large in historic terms, whether you think about them before or after tax in recent decades. They're much higher than they were in decades prior, whereas our corporate tax revenues are only about 1% of GDP after the Tax Cuts and Jobs Act. They were about 2% before Tax Cuts and Jobs Act, and both of those are lower than what we see in other countries where they average about 3% of GDP. US multinational companies disproportionately have profits in tax havens. If you look at these locations that I've listed here, these are the top 20 locations, and 11 of them are havens. Those are the blue bars. And if you look at the havens, they're really quite different from the non-havens. They're little tiny countries with really low tax rates. Whereas the non-havens, which are in the yellow bars, and we could kind of hold the UK in between right now, those are more big economies where you'd expect to see profits if it weren't for this profit shifting problem. Comparing them directly, there's over twice as much profit in those 11 havens as there are in those 9 big economies. The tax rates are wildly different, 4% versus 27%. And those little economies are very little. They only have 1% of the population, 1.5% of those big economies. And so when you looked at this at the eve of the Tax Cuts and Jobs Act, it looked like we're losing about $100 billion a year in tax revenue at those old tax rates at 35%. Obviously, mechanically, it would be lower at 21% than in 35, but it's still an incredible amount of revenue loss due to profit shifting. So one solution that I suggest, and if you want more detail, I have a Center on American Progress report, but I also have a paper with Gabriel Zuckman and Emmanuel Saez on this, is tougher minimum taxation. And this is quite in line with the bills that were just discussed. In the paper, we suggested 21%, but in the CAP report, I also show options for higher rates. And if you can either do it on a global basis or country by country basis. If you keep the rate lower on foreign income than the US income, it's really important to do it on a country by country basis, or you end up creating sort of what I call an America last incentive system, where both high and low tax countries are preferred to the US, which is what we have right now. It's important not to exempt the first 10% return on assets if you want to tackle that offshoring problem. I would also recommend getting rid of the export subsidy for that reason. And it's important to pair these with anti-inversion and other measures that really address the profit shifting of foreign companies as well, and to encourage other countries to adopt. But one of the nice things about minimum taxation is there's a built-in incentive for other countries to adopt, because if they don't tax the companies, then we will. If you look at revenue estimates, the Tax Policy Center recently came out with an estimate of the Biden plan, which is a country by country 21% minimum tax, of $700 billion over 10 years. And I think the reason that they were coming up with a higher number than what I show in the paper with Gabriel and Emmanuel is that they're using the positive profit sample of these two samples of multinationals. And so which sample you use, in part, one is a lower bound, one is an upper bound. It partly depends on how you treat losses through this, but you get an enormous amount of revenue that's between 430 and 770 billion over 10 years. Again, just attributing part of the revenue to the United States, because some of it is picked up by other countries, and accounting for the fact that you no longer have GILTI. So if you want the details on that, they're in both of those papers, and you can certainly email me if you'd like. So in some, if you look at the stronger minimum taxes, such as suggested in those bills, but also in my work, you see that it achieves solutions to all of these four problems. You can have a stronger corporate tax when you're not worried about leaking abroad. It removes the offshoring incentives because there's no exemption for the first 10% return on assets. It combats profit shifting. You collect most of that revenue you were losing due to profit shifting, and it incentivizes other countries to raise rather than lower their tax rate. So it really changes the dynamic of tax competition. So I'll leave it at that, but anyone who's interested in following up with questions, feel free to email me.
Great, thank you so much, Kim. And if you do have questions, don't forget about the Q&A function. We'll definitely get to those at the end of everyone's presentation. Next up, we have Mr. Gregory Jefferson. He is a legislative representative with the AFL-CIO. Thanks, Greg.
Hey, thanks, Susan, for the introduction, and thank you, Professor Clausing, for those informative slides. I guess I'll start off by saying, thanks to the FACT Coalition, Oxfam America, and Public Citizen for bringing us here today to engage in what organized labor considers a very important discussion on the impact of U.S. tax policy on offshoring profits and outsourcing jobs. I will start by saying that the flyer that went out said that the experts were going to be discussing this. I don't consider myself an expert. I'll leave that moniker to Professor Clausing and Didier. But I'm just a regular old labor lobbyist advocating for working families, and have been doing it for a while. Now, what I can offer today is to start my discussion on how organized labor has increasingly fallen victim to outsourcing, and to discuss the importance and the need for legislation like Susan mentioned, specifically the No Tax Breaks for Outsourcing Act, the Removing Incentives for Outsourcing Act, and the Stop Corporate Inversion Act. I guess I'd be remiss by not starting off by saying, thank you very much to Congressman Doggett, Senators Whitehouse, Klobuchar, and Durbin and staff for their efforts in crafting this legislation that seeks to address many of the concerns that we'll be raising today. And of course, I'd actually really want to thank Dan Smith as well, who's always done a great job of working with organized labor and making sure that our efforts are addressed. And thank you very much, Dan, for your efforts over the years. The AFLCIO is the largest federation of independent unions in the world and consists of 55 affiliated national and international unions that are widely diverse in size, scope, and structure, as Susan actually started naming a number of our affiliates. Despite our diversity, there are several areas that bring us all together. And one of those is the concern for the outsourcing of jobs. It's something that we've been addressing for decades now, unfortunately, and it's taken a huge toll on our membership. Our members get downright angry when they discover that tax breaks are rewarded to corporations for sending jobs overseas. Some people just don't understand that, particularly when you have a number of politicians speaking, that bring jobs back, brings jobs back. But in reality, what we're seeing is jobs leaving America. So all too often, these proposals that make it easier to outsource jobs and evade taxes are described in misleading ways and make it hard for both policymakers and the public to understand what is really going on. And as Susan mentioned earlier, I think case in point is the TCJA. We raise extreme concerns with that and the possibilities of making it easier for jobs to be shifted overseas. So in reality, these proposals are nothing but big corporations, once again, gaming the system so working people's tax dollars subsidize taking away working people's jobs, because ultimately what we're seeing is job loss. And organized labor wants a system that rewards those who produce and employ here and not those who abandon America and take jobs overseas. And that's why the labor movement stands for pretty much a simple and clear standard. The tax laws must not in any way encourage investment in foreign countries rather than the United States. And it's quite that simple. And that means the offshore profits of US corporations must be taxed at the same rate and at the same time as their domestic profits, which is what we do not see right now. So there's no economic and political justification for giving corporations a tax incentive to shift jobs and incomes overseas. And Congressman Doggett and Senator Whitehouse have done an excellent job of offering legislation that will address this discrepancy, leveling the playing field for domestic companies by ensuring that multinationals pay the same rate as profits earned abroad as they do here at home. I know Josh is going to go into more specifics on how offshoring and the threat of offshoring depresses wages. So that's pretty much it from the AFL-CIO's perspective. We really treasure working with all the groups, and we are doing whatever we can to address these discrepancies. So thank you, Susan, and I'm welcome to answer any questions that you guys have about organized labor and our efforts in this tax arena. Thank you.
Great. Thank you so much, Greg. And thanks for the plug on the Q&A function. Don't forget, if you do have questions, go ahead and type those in and we'll get to them at the end. As a Michiganian, I completely understand the importance of the auto industry. So I'm super excited to introduce Josh Nasser, who is Legislative Director with the UAW. Josh?
Hi, thanks, Susan. And I again want to just repeat to thank Oxfam and Fact Coalition, Public Citizen for organizing, and all the members of Congress who've really stepped up on this issue. I want to talk about, from a manufacturing perspective, just how offshoring and the threat of offshoring really depresses wages. I mean, you have to look no further than the auto industry, where we've seen over the past 15 years, real wages in parts and final assembly has dropped about 20%. That's when adjusted for inflation. Why is that? We've seen productivity increasing all along, but wages aren't keeping up. Well, there's many reasons, but one reason is this constant threat of offshoring. I can just tell you that in almost every organizing drive around, in the manufacturing sector that we encounter, there is either a direct, even though it's illegal, or an implied threat that if you push too hard, we are going to, we're going to move. We're going to move to Mexico. We're going to go, to China, some other country. And it's been so bad. We've seen, slideshows to this effect that have been shown to workers. So people trying to organize are threatened constantly with the idea, if you vote for a union, you're going to lose your job. But it's not only in organizing, it also comes up constantly in our collective bargaining for the same reason. There's this threat that, hey, if you push too hard for wages, for good benefits, et cetera, forget it. We're just close the operation overall. There's nothing in our collective bargaining that could prevent, a company from, just changing where their investments are overall. So it's this kind of hammer that's above everyone's head all the time. And, addressing it's not easy. We think that legislation talked about today, is an important step, but I want to be clear that, to really rebuild manufacturing and have a strong manufacturing sector for the future, we need to take a comprehensive approach. We got to look at tax policy. Of course, we have to look at trade policy, labor rights, domestic investment, but we really need all these policies to kind of work in concert. There's been a lot of talk over the last few years about trying to have trade policy to really address offshoring. And we welcome the fact that people are talking about trade in that way, but it's not going to be very effective if we continue to have perverse tax laws that actually make things worse. And I think one thing that's really so damaging about the incentives in the recent tax law, TCJA, is that they'll get worse over time, because as corporations plan and they make their long-term investments, long-term planning, the tax incentives factor in more and more. So it's not one of these things where, let's say like the estate tax cuts, like you see immediately a drop in revenue, you see a change right away because the amount of that's subject to taxation changes. This is an incentive that if not changed will get worse. And in fact, the people who voted for it, many won't be in office when it's really doing the most harm. That's why it's really important to change it now. The other thing I just wanted to hit upon is that, kind of underlying all of this is the whole idea of what do corporations, what do the wealthy owe society? What do they owe country? And, there's obviously, we're not faulting people who are wealthy and corporations that are successful. Actually, our members work for corporations who want them to be those corporations to be successful. But I think it's also important that there is a public responsibility, because you can't have a profitable business, you can't have a successful enterprise without having public investment, whether it's education, infrastructure, defense. So the idea that kind of the wealthiest and the most wealthy corporations not paying any taxes don't owe anything to anyone. Totally disagree with that. So really all we're talking about here is leveling the playing field. And this legislation we're talking about today, they're very important. If your boss has not co-sponsored these bills, really encourage you to do it right away. And also, I think I was timing myself. It also it's important that we push this forward regardless of the election results, because if these incentives aren't changed now, I promise you that the problems of offshoring and wages being depressed will get worse over time. And we just can't have that if we're going to have a strong democracy and a strong middle class. So thank you very much, and look forward to any questions you might have. Thanks.
Great. Thank you so much, Josh. I appreciate that. Next up, we have Awesta Sarkash, who is the Government Affairs Manager for the Small Business Majority. Awesta?
Great. Yeah, thank you, Susan. And thanks everyone for joining, and Oxfam, in fact, for putting this together. Just quickly, Small Business Majority is a national nonprofit organization. We have a network of over 70,000 small businesses and well over 1,000 business and community organization relationships. And we are really encouraged to empower America's small businesses and diverse entrepreneurs to, build a thriving and inclusive economy. So, for today, the various pieces of legislation that we're discussing serve to address a key risk that governments and small businesses alike face, which is multinational corporate tax avoidance. And the aggressive tax policies, aggressive tax planning strategies employed by multinational corporations shift the burden to taxpayers, and we see that especially true for small businesses. And so they're typically operating on an, not level playing field, and small businesses aren't able to take advantage of some of the accounting gimmicks to dodge taxes, and so they're just kind of put, so between large multinational corporations, small domestic businesses, which means ending the ability of multinational to engage in offshore shell games. So I'm just going to kind of explain why that sort of component puts small businesses at a competitive disadvantage. The first being that this really profit shifting to access benefits are unavailable to small businesses right now. Small businesses, even those operating in multiple countries, don't engage in complex profit sharing schemes, either because the benefit is nominal to justify the cost, or because they need ready access to their capital. Access to capital is, primary concern for small businesses, and that's certainly true for women and minority-owned businesses who have particular barriers in accessing capital. By contrast, multinational corporations move their profits, as we've heard folks talk about, offshore to lower their tax costs and justify the refunds with a negative effective tax rate. So a 2019 report by the Taxation that some of the biggest US companies actually have negative tax rates ranging from negative 1.2% to negative 4.6%. So it's pretty significant there. And that affords them an unparalleled leg on small businesses when, small businesses are the heartbeat of our country's economy. And we've obviously seen that as a result of the COVID-19 pandemic. And so this practice is really unsustainable, and it's bad news for our economic growth. And then, secondly, we see that by avoiding taxes, multinational corporations unfairly shift that tax burden to small business owners and other consumers. Right now, the tax code doesn't really do a ton for small businesses, which I'm sure is not too much of a surprise to people, particularly because the tax incentives that are available are sort of targeted towards industries that a lot of sole proprietors or businesses with fewer than like 3 employees don't actually get the benefit from. So, in the 1950s, the collection of corporate taxes accounted for an average of like 28% of our tax revenue, and now it accounts just for 7%. So that means individuals and small business owners are left to pay the tab. And they actually account for around 86% of the total US taxes right now. So by opting out of paying taxes, these corporations refuse to invest in public programs for which all US businesses benefit from, like infrastructure, workforce development, and education. So, to give a little bit of perspective on the small business side of things, we've polled our small business owners pretty regularly on the issue, and we had a poll back in 2017 that found 70% of small business owners feel that they're either somewhat or greatly harmed by big corporations using these tax loopholes to avoid taxes. And then in that same poll, we found that 85% of small businesses want corporations and wealthy Americans, wealthy corporations, to pay their fair share of taxes. That's kind of outlined thus far. And then that, for more recently, there was a poll released 2 weeks ago by Main Street Alliance that confirmed just that. Their polling found that likewise, 87% of small businesses want to see profit share, want to see multinational profit shifting to avoid paying taxes. They see it as a problem. And so we've sort of touched on this already, but I think the solution, and I had mentioned this on the previous panel, transparency around corporate tax planning is the first step towards level the playing field, certainly for small businesses. I think we need to go a little bit further than that. We need to equalize the tax rates on domestic foreign products, applying that rate for foreign profits on a per country basis, and codifying strong anti-inversion measures to prevent multinational corporations from falsely claiming foreign residents, so that we can ensure that small businesses are actually have the resources, have the funding, tax incentives to operate on a level playing field, increase competitiveness, and really uplift our small business owners, particularly women and people of color. So I'll stop there.
Thank you, Owisa. I appreciate that. So now I'd like to invite Didier Jacobs, who is Senior Policy Advisor for Oxfam America, to go ahead and wrap us up.
Thank you, Susan. This briefing is timely because international negotiations are underway right now to set a global standard for the GILTI and BEAT taxes. And that's a key development because it takes care of the main counter arguments against the no tax breaks for outsourcing act. And that's the competitiveness argument. So if other countries start taxing the foreign profits of their multinational companies, it creates more room for the US to tax the foreign profit of US companies more. And indeed, countries all over the world are seeking new revenue sources in the context of the pandemic and the economic crisis. But even before that, countries like France were really looking into ways in which they could tax the revenues of a company like Amazon, which does a lot of business in France, but which France so far cannot tax because Amazon does not have a physical presence in France. So the OECD in Paris is facilitating negotiations among over 130 countries on a couple of related international agreements. One agreement has to do with the reallocation of taxing rights over digital companies in particular, so the Amazon problem. And the second agreement is about a global minimum tax for all multinational companies in order to curb tax avoidance and tax competition in all sectors. And the US GILTI and BEAT are the inspiration for this global minimum tax. So the idea is that all countries would adopt taxes similar to the GILTI and BEAT, but according to a global standard. And last week, the OECD released the blueprint for that standard. And so I can go in more detail in the Q&A or offline, but it's of course pretty complex. But just to highlight a couple of points, Professor Closing mentioned the importance of applying the GILTI per country, especially if the rate is low. And that is taken into account in that blueprint. So that's kind of the idea of the Klobuchar bill would become part of the global standard. On the other hand, Professor Closing also highlighted the nefarious impact of the 10% exemption for tangible investment. And that, unfortunately, is also part of the global standard. And so we don't like that. That said, nothing is settled yet. This is just a proposal by the OECD. They hope to finalize negotiations on this by the end of April 2021. There is also some kind of informal understanding that the current US GILTI would be sufficiently similar to this global standard so that the US would not necessarily need to change its US GILTI, but still that's not decided either. So everything remains open, and it's really an opportunity to influence these international negotiations. And I'll just end by saying that there is very strong political momentum to conclude these negotiations, because if there is no global agreement, governments like France, but many others, are poised to take unilateral action to tax digital companies in particular. And since many of them are American, the Trump administration has vowed to retaliate. So multinational corporations face the risk of having a maze of unilateral taxes in each country, which would tremendously increase administration costs and the risk of litigation, the risk of double taxation, and so on. So there is actually a real demand from multinational corporations themselves to have some kind of global agreement. And so that means that we have some leverage over them to make sure that there is a strong global minimum tax. Over to you, Susan, for some Q&A.
Wonderful. Thank you so much, Didier, and to all the panelists. A reminder to please use the question and answer function that is in the Zoom window. We did have one really great question that was something I neglected to say, and that is that this recording will be posted after the fact. And so if you missed any of our great panelists, we will have the whole recording available, and that will be on the FACT Coalition website. So thank you for reminding me to mention that. So we don't have any questions yet, so please put them in, but I'll use my moderator prerogative and go ahead and ask the first one, and that is, with all of the support, both the huge amounts of co-sponsorship we've seen on the No Tax Breaks for Outsourcing bill on the House side in particular, as well as the large amount of nonprofit and organized labor support for this legislation, why do you all think it has not yet passed into law? And how can we make it happen? Maybe we'll just go in order. Kim, do you have thoughts on that?
I mean, I think with a lot of these issues, it's a matter of political will. Both the Republicans under Chairman Camp of Ways and Means some time ago and Obama administration proposals had suggested a revenue neutral corporate tax reform where basically the headline rate would come down, and that would be coupled with revenue raising on the international side. And I think what we saw instead in the Tax Cuts and Jobs Act was revenue neutrality on the international side and revenue loss on the domestic side, which turned into a $2 trillion worth of deficits from that bill altogether, which isn't entirely on the corporate side, but at least half of it is. So I think it's always easier to cut taxes than to raise them, but eventually the US is a very low tax country. If we look at us relative to all the other countries, whether we look at the individual side or the corporate side, but particularly on the corporate side, we're a very low tax country. So if we don't want to pay for everything with debt, which I think at some point gets a little untenable, there is room for some debt, but then we'll have to think about revenue raisers. And given what's happened to income inequality over the last 3 decades, I would hope that a new Congress would consider seriously raising taxes on those at the top. And one way to do that is through capital income. And the only way to tax capital income is with a strong corporate tax. So I'm hoping the logic of this will ultimately persuade people in the long run, even though in the short run, people have been sort of giving out tax revenue with this sort of more candy store model on the Republican side.
Great. Greg, do you have thoughts?
Yeah, no, I think that Professor Clausing hit the nail on the head on a few areas. But if you look at the inequality of wealth, if you look at our country's need for infrastructure, and I'm getting to answer your question, I think it would make sense that politicians and folks would realize the need for revenue raising legislation like this. But at the same time, I think it's very difficult for members of Congress to stomach the pressure that they may get from outside sources to move forward with progressive legislation like this. Hopefully, a change in administration and a change in the political dynamics in the Senate, we would be able to move forward with this. But I think it's a combination of the inability to stomach the pressure that you may be getting from other places to move forward with legislation, despite the fact that the need for so many different areas of revenue for different reasons is quite clear, and I think they're well aware that there is a extreme need for revenue.
Great, thank you. Josh, do you want to take a stab?
Yeah, absolutely. So, I mean, just to add what was already said, I mean, the political power of of the corporations who are opposed to this is hard to over exaggerate. You just have to look at the number of registered lobbyists and where they come from to get an understanding of that. You just have to look at, frankly, campaign contributions, and then Supreme Court decisions like Citizen United. And we're in election season, so you can kind of see it all now. So I mean, this is extremely tough stuff to vote on, and it really will only happen if there's if elected officials feel like there won't be a big political penalty. And how does that happen? People need to engage. If people don't engage, great. No offense to Greg and I, but we're gonna lose every time if people aren't weighing in locally and getting active. So that's what we need more of to have something like this happen. It's not going to happen as an inside deal on Capitol Hill.
Mm-hmm. Agree. Get that money out of politics, get the grassroots engaged, and we'll win. But Awesta, do you have thoughts?
Not really more than what people have said. I think we have the same sentiment, the squeaky wheel gets the oil. So.
Mm-hmm. DDA, last thoughts on this question?
Yes, so in addition to, of course, the difficulty of raising revenues, there is, I think, that a competitiveness argument that is often branded, and this international agreement I referred to could really decrease that a lot. But I'd like to take this opportunity to really unpack that word competitiveness. In fact, the legislation that we propose would increase the competitiveness of the American workers. When multinational companies talk about competitiveness, what they really talk about is competitiveness on global capital markets. And the way you design your tax, international tax, there is a trade-off between the two. And so what we call for is really putting American workers first and designing the tax system in that favor, and not putting capital first.
Great, thank you. And thank you to Caitlin, who's put in a question on the Q&A function. And if you want to put it anonymously, feel free, but we have this one here. And this is to everyone. Any advice on pushing back on messaging that raising corporate tax rates is an indirect tax on American workers? So, yeah.
I would love to talk about that. I mean, I've written some papers on this, and I think one way to push back is to just look at the data, because the mechanism that they're talking about for helping workers is the idea that corporate tax cuts should lead to a lot of investment. That investment should increase the productivity of workers, and that should show up in higher wages. But we haven't seen that in the wake of the Tax Cuts and Jobs Act. And further, we don't see that in the UK. We don't see that in Germany. We don't see that in Japan. We don't see that in Italy. If you look at every big country that has tried this experiment and what's happened to their wages after their big corporate tax cuts, in no cases did it show up as higher wages. So, I mean, the proof is in the pudding. If you look at the actual outcome, there's just no evidence that really supports that view. And I think you could ask American workers, like, did you feel that wage increase that they promised you? And they're going to tell you that they didn't. I have a paper that's actually called Fixing 5 Flaws of the Tax Cuts and Jobs Act, and section 3, I think, of that paper goes through that evidence in a lot of detail. So anybody who wants, quick graphs and explanations of why that argument is so flawed needs, just email me and I'd be happy to send you whatever evidence you need. But I think we also need to remember that the political power of these companies has led them to find a big cadre of experts who are willing to say that out loud, but that doesn't mean that that's what the data show.
And Kim, correct me if I'm wrong, but not only does the evidence not show, but don't we have evidence that corporations actually cut jobs during some of these tax cuts? So I mean,
yeah,
not only did they not raise wages, they eliminated.
Yeah, totally. Yeah, they cut jobs, and there's evidence that the offshoring incentives were responded to. So there's a nice paper by 4 accountants at the University of North Carolina, I believe, that shows that the companies that got the largest tax cuts under the Tax Cuts and Jobs Act actually expanded investment abroad much more rapidly than at home. So there's direct evidence, to the extent that we have evidence on such a young law, there's direct evidence that it was perverse, that it was working in the opposite direction of the interests of US workers.
Mhm. Anyone else want to weigh in on this? I realize we're also at time, if not a minute or two over. So, but I don't want to cut off any of this great discussion.
I could be really fast on this. I mean,
Yes, please
you know,
do.
in addition to what's already been said, I mean, just to take the, you know, so the facts, just look at how much money was used for stock buybacks instead of those wages. That's clear. But the other thing is just how cynical, what a cynical argument. You know, because you think, I hear from like pharmaceutical companies too, et cetera, you know, this whole idea that any dollar of profit, you know, immediately, you know, will hurt people. Like there's no fat that could be cut when it comes to corporate compensation. There's nothing that could be done as far as advertising. I mean, you know, it's incredibly cynical, and it just isn't factually backed up. So, but you know, I also don't want to understate how much pressure people are under. But you know, the facts aren't on the side of that argument whatsoever.
Great. Since we're at time, definitely understand that you can send us emails. We'll be providing this material and the recording of this after the fact, and would be very happy to come in as a coalition and meet with your office, talk about the issue one-on-one, make sure that you have all the information you need to get your bus on this bill. So just thank you again to the panelists. We really appreciate all of your thoughtful remarks, and thank you to you attendees for being so engaged and for listening to what we had to say today. So again, we'll be emailing this out along with some additional materials, and I'm just looking forward to having ongoing discussion with you about how we can close these tax incentives that have incentivized offshoring. So thank you so much for taking time to be with us today. Have a lovely afternoon.